Good evening, everyone. Once again, we welcome you to the next session, and I believe this would be the one of the most important and one of the most interesting session in the stock market, which is to know and to how to select a stock based on fundamental analysis. And I'm sure, and being a chartered accountant, every one of us would must be dealing with the annual reports and all the investor presentation reports on a day-to-day basis. But then, how to select a stock would and that too a multi-bagger stock would be the most interesting part of your investing journey. And to guide us on this topic, we have one of the most finest fundamental analysts in the India, CA Siddharth Vora. And to give a brief introduction about the speaker, Siddharth Vora heads the investment research and product strategy at Prabhudas Lilladher. Sir is a chartered accountant, CFA, and has done their Master of Science in Management and Business Excellence from the University of Warwick, UK. Sir is a SEBI registered research analyst and an investment advisor. Since joining the firm in 2016, he has been responsible for setting up Quantify, the quant research and investment units, while overseeing the digital and fintech transition of the PL group. His innovative, original, and creative thinking has led him to create proprietary investment frameworks, quant tools, and strategy for which he is very popular. So with this brief introduction, I would like to request Sir to please take the session further and to guide us, and also in the meanwhile guide us like how to really identify the multi-baggers, so which would be helpful to all the investors in their long-term investing journey. Thank you, sir.
Thank you so much for such a kind introduction, and I will try my best to help you all to able to identify stocks on your own, and obviously with guidance of other experts around you. And I think I'll just straight jump into the presentation. And let me just share my screen 1 second. So can you guys see my screen?
Yes, sir.
Okay. So basically, I'm going to talk about fundamental analysis and stock picking. This topic is very deep, very nuanced, and very broad. But what I've tried to do here is simplify the whole exercise, templatize it, and give you guys a framework to work with. It's really important in investing that you work with a framework, a set of rules, a system, so that stocks can walk in and out of that framework. Every time you don't have to reinvent the wheel. Every time you do not have to do a completely new type of analysis. You know what is your comfort zone, how you want to invest. You have a set of rules for that. And then you analyze a stock in the background, in that given background. And that is what is the key exercise that I'm going to take you all through today. So everybody, I'm assuming, is a CA already. So you guys must be well versed with financial statements, ratios, accounting, all of that. I'm also a CA and have done all this in my studies, so I remember. Over and above that, you all must be having a theoretical sort of idea of the two basic approaches of fundamental analysis. One is the top-down approach. The other is the bottom-up approach. I'm not going to waste too much time explaining these approaches, but I will quickly tell you in a very short way how to really use this. So in a top-down approach, it's more of a macro analysis to start with. How is India doing? What is the GDP growth in India? What are the inflation forecasts? What is the monetary and interest rate regime? How is the government spending coming along? How is the tax collections coming along? You need to understand all those things just to form a broad view. Okay, India is going to do well over the next 2, 3, 4 years, or India is going through a slow down phase in the economic regime. Once you then form the basic thesis, कि अच्छा इधर से मुझे तेजी लग रहा है, इधर से मुझे economic growth नजर आ रहा है. That's all you need to know. When you're selecting stocks, the only thing you need to know is whether we are in an economic growth regime or in an economic slowdown regime. Once you established your economic regime, you need to narrow down which industries are going to do well. Either some industry can do well because of some regulatory change, or it can do well because of organic demand, or it can do well also because the costs in that industry has come down. There are many factors why an industry could do well. To make it more relevant to what is happening in India right now, I will give you all a couple of ideas. So chemicals is a sector. Chemicals and pharmaceutical API, particularly these two sectors में अभी क्या हो रहा है कि there are a lot of duties that are being placed on our Chinese competitors. So what is that doing for the Indian manufacturers? It's giving us a chance to compete with China at an equal or lower cost. In turn, what that is doing is it is helping us improve our realizations and volumes. When realization and volumes both grow, the overall chemical industry goes through a nice cycle of sales growth. And I'm sure all of you all have studied operating leverage. When sales grow and fixed costs don't grow at the same level, your operating leverage kicks in, your margins expand, your return on equities go up. And that's a whole virtuous cycle that we are entering into. Similarly, for tires also, there were anti-dumping duties enforced on different cheaper imports, and that benefits the tire industry directly. Like this, these are just very simple examples. There is more detail in terms of how you got to look at different industries, whether it is metals, cements, FMCG, etc. And what are the key drivers of a particular industry? Once you've narrowed down, okay, growth lag raha hai, and ये 5-6 इंडस्ट्री में अच्छा टर्न अराउंड लग रहा है, अच्छा ग्रोथ का रनवे लग रहा है. So 2 of your things are done. Now, simple. Go online, filter stocks, buy those industries and sectors. Now you have a data set of companies. कि अच्छा, after these 6 industries, ये 50 companies are coming out. Now the real fundamental analysis starts. How to shortlist from 40, 50 companies to maybe 5-10 stocks that you want to own in your portfolio. And this is the whole journey which we need to cover in fundamental analysis. So far, so good. Okay, so I'm just going to take you all through the entire process from economy and markets to magic of compounding, how that whole journey evolves. As I told you all need to know the macro and monetary regime. You need to have a view. A cursory view is okay, but a view is important. Other than that, you also need to be aware of 3 things, only 3 factors in the markets: sentiment, risk appetite, and momentum. These are short-term factors, not long-term factors. When I talk about sentiment, I need to evaluate whether the market is going for riskier assets, whether there is an ensuing bull market, whether the liquidity is so much that all the stocks are being bought at any prices, whether only quality stocks are bought, whether cyclical stocks are bought. Once I know that, I know what mode the market is in. And that will tell me if the market is in a bullish sentiment or a bearish sentiment. After that, I need to evaluate risk appetite. In risk appetite, I have to look at different global asset classes and Indian asset classes. I need to see if the money is flowing into riskier assets or risk-free assets. For example, in March, so a very strong move out of equities and a move into gold, liquid funds, GSEC, etc. This clearly shows me one thing, that the market is in a risk-off mode. And when the market is risk-off, equities are going to be beaten down. After that, once the global liquidity regime unfolded, we understood 2 important things. One, that mid caps, small caps, large caps, cyclical stocks, all the stocks are participating in the rally, which means that the market is coming to a broad-based bull run, and that is indicating me one clear thing: risk on. And once I know the market is in risk on, I have confidence and I have conviction to size my bets, to buy stocks, to confidently enter the market. And the last factor that I need to understand is momentum. Among the different asset classes, where is the momentum? If you saw from Jan to March, we saw there is momentum in gold. After April, we saw equities are in momentum. So sticking to the asset class with momentum is very, very important. Okay. Once we are having a clear view on economy and markets, again, we need to look at sector and industry. I already explained you all in the previous slide, but I'm just going to take you through key facts. Volume. Where are we seeing volume growth? Where are we seeing margins expand? Where are we seeing the opportunity size being massive? Where are we seeing regulations change in favor of a particular industry? Once these two are done, then you have your 40-50 stocks. Now the challenge is, ye 50 mein se 10 pe kaise aun? First step, very simple. Use a mechanism called red flags. What does red flags tell you? Red flags is a perspective of looking at stocks with the order of eliminating them. Governance issues, shareholder pledge issues, very high debt to equity, very low interest coverage, no liquidity on the balance sheet, not enough cash reserves, least efficient player in the industry, accounts are not transparent. There could be multiple ways to identify red flags, auditor resignation, etc. Once I've made my 40-50 stocks, put them against these red flags, I will easily be able to eliminate at least 20 to 30 stocks. That means I'm now down to 20-25 stocks. Now, what do we do? Two things, quantitative evaluation and qualitative evaluation. Quantitative evaluation, what are the tools that you can use to evaluate a company on a quantitative basis? We need to look at, as you all must be knowing, profit and loss, balance sheet, cash flow, ratios, and valuations. These are just the areas where you need to look at. I'm not telling you what to look at yet. I'm telling you where to look at. So we look at these financial statements. Now with databases and technology evolving, you all can just go online, search a company. All of these things that I'm just mentioning are going to be one click away, whether it's the profit and loss, balance sheet, cash flow, or ratios, including valuations. So now when I'm looking at the quantitative aspects of a company, I'm going to take you all through details of what to look at, but that's going to come ahead. For qualitative, what do I need to look at? The management discussion and analysis. I need to listen to the con calls, management interviews, and interactions. This will tell me the subjective view of what the company thinks, how its business is going to do in the next few years. And this becomes very important to build in your analysis. Now, how to select a stock from these shortlisted stocks, how to narrow it down to portfolio level stocks. You need one thing, and this is the golden rule, only one golden rule. You need an investment framework. Without a framework, you cannot be a consistent investor. If you don't have your own framework, you will never be able to identify stocks that you think will do well. For simplicity, I'm going to share two frameworks that I have personally created. These are proprietary fundamental frameworks. You guys can use this also or create your own framework. I've done a lot of research on different global investors from Warren Buffett, Peter Lynch, Phil Fisher, etc., to then arrive at my own framework of investing in Indian equities. I'm going to take you all through Crops Up and MOSAIC in the next few slides. Finally, in stock selection, three factors are critical. We call it the holy trinity: quality, growth, and value. Quality is a very, very big aspect, and you will have your management quality, business quality, fundamental financial quality, balance sheet quality. A lot of different things will come under quality. Growth is again simple. How big is the size of the opportunity that the industry is in? What is the trajectory of growth? And what is the longevity of growth? Is this company in a sector that can be disrupted by the new high-tech companies? Or is this company in a sector which has enough entry barriers that it will ride through the cycles, ride through the disruptions, and still continue to emerge as a winner? This is what is really subjective, really important. And every investor must focus on answering these three simple questions. And value, again, I'm going to take you all through a little more detail on the value aspect. But broadly, there are two ways to value companies: relative valuation and intrinsic valuation. In relative valuation, I'm going to see how a particular company in a particular industry is valued against its peers. And in intrinsic valuation, I do not care about the peers. I care about the history of one particular company and the future of one particular company. I look at cash flows, more importantly, free cash flows. I plot them into the future and discount them back to know what is the present value of future cash flows of this particular company, and therefore what is the market cap of the company. And now, if the company is trading below its intrinsic value, I should ideally purchase it. And if it's trading above its intrinsic value, then I should justify why I want to purchase it above that intrinsic value. Now, once you've decided which stocks fit into your quality, growth, and value trinity, you need to constantly monitor and rebalance your portfolio only when needed. You need to know that the investment thesis with which you bought a particular stock still holds true. The only reason for you to sell a particular stock is if the fundamentals have changed, the regulations have changed, the competitive structure has changed, etc. You cannot sell a stock only because a price has come down or because a price has gone up. You bought it with a 10-year view, hold it with a 10-year view, and sell it only if your basic thesis has changed. And finally, if you buy with conviction and hold with patience, you get what we call the magic of compounding. And the rule for conviction is simple: buy what you know and know what you buy. Because if you buy something you don't know, you don't understand, you will never be able to hold it if it corrects. If you bought a stock at 100 thinking it will do well, fully knowing what the business is, how the industry is, etc., you will be able to hold that stock even if it corrects 15%. Because you know कि जो business खरीदा है वो 10-15% का movement के लिए नहीं खरीदा है. It's a long-term ownership in that industry, in that business. But if you invest in a stock that you don't have a full grip over, you will be scared. If the price corrects 20%, you'll be like, अच्छा, ये तो मुझे पता नहीं है क्यों हुआ, but maybe things are bad, let's just sell it. So buying with conviction and holding with patience is very, very critical. This is more slides on industry analysis, but I've broadly explained this to you all. So I'm not going to waste too much time on this. All of you all must have studied in your ITSM strategic management course. You have SWOT analysis, you have pest analysis, and you have your Porter's 5 forces model. This is very basic and very elementary. So I'm not going to really spend time here because I'm assuming you guys already know the basics of this. In Porter's 5 forces, I'm going to spend 1 minute because it is important in the investment framework that I have built. And over there, it is really important to identify entry barriers, which in the investing community, we call moats. Identifying moats is very critical to how long your investment horizon can be. The deeper the moats, the longer the investment horizon. Again, how do you identify the moats around a business? What is the threat of potential new entrants in an industry? Is it easy to enter this industry? What is the bargaining powers of buyers versus the manufacturer or the seller of a product? This again will show you the pricing power of a company. And if the company has good pricing power, through the ups and downs of economic cycle, it can maintain its margins and therefore its ROE. And that is why understanding bargaining power and pricing power becomes very critical. Also, there are many industries or companies where the suppliers dominate the trade. We don't want to invest in such industries. We want an equitable industry or an industry where there is a negative credit cycle, which means that the supplier is giving you the stock today, but is telling you, pay me later because I trust you, you are that good. The other scenario, the supplier tells you, first you give me money, then I will give you the stock because I don't trust you. And therefore, understanding working capital, debtors and creditors becomes very important because it highlights the soft power of a company in many ways. Again, threat of substitutes and how easily replaceable a particular product is. You need to be aware of that. And complementary goods and service provider. कि actually differentiation क्या है कोई product या company में, ये समझना बहुत जरूरी है. So in company analysis, as I've told you all, we have qualitative factors and quantitative factors. I've given you all a brief on qualitative, and I'm going to also take you all in detail through the quantitative factors. So let's straight get inside. This is apna CPT, IPCC, CA final, all in one summary. Everything that is relevant to investments is summarized in one slide for you. This should be a very, very important slide for you. This is all the accounts and finance you need to know to become a decent to good investor. 5 things. I'll take it one by one. Balance sheet. In balance sheet, I don't need to construct it. I need to understand it. What do I need to understand? What is the capital structure? Net worth kitna hai? Long-term debt kitna hai? Short-term debt kitna hai? How is this company funding its business? We like companies that don't have long-term debt or have low manageable long-term debt. We also like companies which have manageable short-term debt. Anything into extremes in terms of debt is never a healthy sign, because when the economy turns around and goes down, you cannot service your debt. And then you go into a very, very long drawn cycle of negative returns. And that is something which is easily avoidable. Working capital is the second piece, which will tell you a lot about how the company is operating. How good is it in its particular industry? How fast is it selling its inventory? How quickly are the debtors paying the company? How long does it take to pay its creditors? And how much cash does it have on its balance sheet? All these 4 pieces are extremely, extremely important. If I have a lot of inventory and I'm not able to sell, what does it tell me as an investor? कि कंपनी ने उसका पैसा इन्वेंट्री में डाल दिया है, पर इन्वेंट्री बिक नहीं रहा है. Is that a good sign? No, it's not a good sign. कंपनी ने माल बेच दिया है, पर people are not paying them on time. So कंपनी का पैसा debtors में अटक गया. Is that a good sign? Again, not a good sign. It is also not a good sign if the company is not paying its creditors on time. Timely payments shows that the company has integrity. So when you're looking at a balance sheet, have these perspectives in mind so that you're able to come up with a conclusion on that company. Just reading the numbers and saying, "Acha, iska itna inventory hai, itna," so what? What do I get out of it? Focus has to be on analysis. How much assets are intangible and tangible? Again, this is very important. We don't like companies with a very high proportion of intangible assets on their balance sheet. Intangible assets can be viewed from an investor perspective, but as an off-balance sheet item, not as an on-balance sheet item. The difference between your book value or your intrinsic cash flow and your market cap is your brand goodwill, and that is the intangible value I am willing to pay you as an investor. But if you've already recorded for that on your balance sheet, it is not good. It is not a healthy sign. Tangible assets will also give you a very important factor to look at companies. Asset heavy companies and asset light companies. So FMCG stocks, IT stocks, they don't have tangible assets because they don't need tangible assets. But when you look at your metal stocks, cement stocks, they all need factories. And therefore, their fixed assets are very heavy. And therefore, in asset heavy companies, you will look at their fixed asset turnover. But in an asset light company, no need to look at the fixed asset turnover because it's going to be high because they have very low fixed assets and very high returns on those fixed assets. So the point here I'm trying to drive home is be aware of these concepts, how to use them from an investment perspective, and use relevant concepts for the relevant industries and companies. It is not one size fits all. Now, P&L, this is probably the simplest piece to understand. How are the sales growing? What is the trend of sales growth? Are there any significant changes in cost structure on the higher or lower side? There are phases in a company when the company is heavily reinvesting, increasing the number of employees, increasing the marketing expenditure, things like that. So the cost structure is changing. There are also phases when some big fixed cost is coming down, and that is the time to enter a stock because there will be a huge delta. When your fixed costs go down, your margins expand tremendously, and so does your ROE. So therefore, to be aware of cost structures is very critical. I want to see how the gross profit margins are in terms of trend and consistency. I don't want to buy stocks in companies that have a falling trend in their gross profit margins. Also, I don't want companies where the gross profit margins are very inconsistent and very cyclical. To be a patient investor and to sleep peacefully, you want to own companies that are consistent in what they are doing. Very high beta stocks, which have, very big moves in their margins, 25% EBITDA margin, 4% EBITDA margin, 12% EBITDA margin. That is very tough to monitor, manage these kind of stocks. Again, I gave you all a highlight of fixed expenses and variable expenses. EBITDA margins are very important because without depreciation and interest, at an operating level, how much profit is the business generating? It's really, really important to evaluate that. Again, I want to see the trend of interest. Is the trend of interests coming down? Is it going up? Is it maintaining? Things like that. Once we are done with balance sheet and P&L, the most important piece comes in, which is the cash flow statement. So on the street, the saying is, you can lie in your P&L account, but you cannot lie in your cash flow statement. Which means if your cash flow is not tallying with your P&L in terms of the broad trends, EBITDA बढ़ रहा है, cash flow from operation बढ़ना चाहिए, cash flow from operation बढ़ रहा है, free cash flows दिखना चाहिए. If these things are moving in a synchronous way, you know that this company is clean, it's transparent. But if you see some companies with very high profits, but no cash, it's a clean red flag. Stay away from such companies. Also remember, this rule does not apply to banking companies and mainly financial companies because their business structure, balance sheet structure, everything is very different. When I'm talking about cash flows, I'm talking about manufacturing or service companies, not financial companies. So do keep that point in mind. After you have a detailed idea, okay, what is the capex intensity? How much does the company need to borrow on a regular basis? Is the company repaying its borrowings on a regular basis? Is it able to generate enough free cash flow for shareholders like you and me? Once we have a grip on that, then we know, yes, this company is good, strong, clean, and transparent. Finally, what I also want to look at before really buying a stock is few important operating metrics. What I have shown you here is a snapshot of operating metrics from different industries. Operating metrics differ from industries and companies. They are not the same. But as an investor, when you read the balance sheet and try to analyze it, you will come across 3, 4, or 5 critical metrics which you want to track on a consistent basis as an investor. In retail companies which are running stores, you want to see if same store growth is consistent and increasing. In a telecom company, you want to see whether its net subscribers are getting added or subtracted. So Jio and Bharti were adding for a while. Vodafone has been reducing for a while. That gives you an idea whether customers are increasing. The second factor for telecom companies is your ARPU, which is your average realization per user per month. For banks, you need to know net interest margins and non-performing assets. I'm just giving you examples so that you're aware that for every different industry, there are 3 to 5 critical metrics which you need to be aware of. And before you ever buy a stock, you should have your Excel sheet ready with at least 5 years of data of those 3 to 5 operating metrics. Once you've done the first 4 pieces of financial statement analysis, you come down to the last one, which is both a science and an art, which is valuation. When you are valuing a company, the simpler ways are relative to peers and relative to history, which means historically, if a stock is trading at 35 ka PE, I should be cautious if it's now trading at 60 ka PE, because my returns will become very narrow from here on. The other way to look at it is the stock was trading at 35 ka PE. Now it has re-rated to 60 ka PE. What is the justification for this re-rating? Has the ROE gone up? Has the margins expanded? Has the market share increased? Has the realizations improved? Has the volume growth been much higher than industry volume growth? If you are able to justify increase in a multiple ka rating, then you can buy a stock. Similarly, what relative valuation will do is provide you a very simple template of valuing stocks. If I'm comparing TCS, Infosys, Wipro, and HCL Tech, 4 IT stocks, for example, what do I need to understand here? If a certain company is trading at 30 PE, then a next company is at 25 PE, the third company is at 20, and the fourth at 15. I need to ask myself, why is there a difference in these valuations? Is it Infosys ka ROE 20 hai, TCS ka ROE 30 hai, and because it has a consistent ROE of 30, market is willing to pay a higher premium for TCS. Like that, I need to understand the correlation between fundamentals and valuation multiples. If I look at stocks like that, I will be able to justify a 30 ka PE multiple for a TCS, which is having a 30% ROE, and a 15 ka PE multiple for XYZ company, which is having a 15 or 12% ROE. So it's very important to plot key fundamental metrics, plot key valuation metrics, and see if it is in sync. Many a times you will find big opportunities when you just do this simple plotting. For example, if on a fundamental grounds, the ROE is similar, the margins are similar, the growth is similar, but the valuation is lower, this is your chance to buy that stock, because if the fundamental characteristics of a company are very similar, but the valuation has not caught up, a very high probability that there will be a re-rating in that stock. I don't know if you guys follow the markets, but we saw a very strong re-rating in a lot of IT stocks because their growth numbers became similar, their ROE expansion happened, margins expanded, a lot of other factors like that. So when things converge into similar fundamentals, there is always an opportunity of value re-rating, and that is a good entry opportunity for you to identify and buy stocks. The other concept in valuation is intrinsic value. All of you all must have studied your discounted cash flows in CA, and this is nothing more complicated than that. It is a simple application of discounting. You need to be aware, if it's a very risky company, I need a higher discounting rate. If it's a FMCG, Hindustan Unilever, Nestle type company, I can do with a lower discounting rate. So from a practical standpoint, what is important to understand is how to use discounting rates, how to use growth rates dependent on a certain industry. And this is all that you need to know about finance and accounting from an investment perspective. Again, this is a snapshot of all the ratio analysis that you must have studied from CPT to CA final. And this is again, all you need to understand from an investor perspective. I have taken you all through quite a few things when I was explaining you all balance sheet, P&L, etc. But simple ratios like your debt equity, interest coverage, ROE, ROC, asset turnover ratios, gross profit margins, price to equity valuation multiple. Just be aware of these and know how to use them. This is particularly important because the only focus as an investor you should have is whether economic value is added. If economic value is added and the company has done that consistently, that really makes it a good candidate for a long-term investment. The meaning of economic value is very simple. If the returns on capital is greater than cost of capital, we like that business. And to further simplify this for you, I will say as a hard filter, use 10. Any companies with returns on capital less than 10 usually doesn't justify the equity risk premium, doesn't justify the cost of capital. And therefore, you can use this as a simple metric to filter companies out, which is ROE and ROCE greater than 10. This will not solve your stock picking solution. This will just help you eliminate a lot of companies. Other than this, from this slide, I think I've covered most of the concepts before. Now, let me introduce to you my proprietary investment framework for stock selection. I've called it MOSAIC. MOSAIC, the word means when small pieces of art come together to make a large, beautiful piece of art. And the same concept applies also in the investment industry, where if few important points in a business are tying in together, we can find a really nice long-term sustainable investment opportunity. So in MOSAIC, we have divided every letter into 2 factors. Management excellence for M and moats is the second one. How to evaluate management excellence? Again, there are a lot of things like corporate governance. Is the management delivering on what it is promising to deliver over a long period of time, for which you need to go through the con call transcripts and understand कि 5 साल पहले ये बोला था, over the next 5 years, has the company delivered on that or not? Then moats is a very subjective analysis. Everybody has to understand what moats does a particular company have. Is it the largest market share player? Is it the best brand in a particular industry? Is it the cheapest producer or provider of a certain product? Does it have the largest distribution network? Does it have intellectual property and patents? What does the company have which will enable it to fight competition? This is what you should understand. O is again to do with opportunity size and outlook for growth. I've explained this to you all before. I'm not going to go into this again. S is for 2 things: scalable and sustainable business model. Scalable and sustainable means I don't want companies with one-time profit, large profit, and then I'm not able to, sustain that kind of one-offs. And by scalable, I mean, once I get DMart. DMart is an example of a scalable model. What did Mr. Damani do? He got the first store right and he ran that store for 3 years. After he cracked the first store at a unit level, unit economic profit, after that, he started scaling up. 5 stores this year, 10 stores next year, 15 stores next year. Now they are upwards of 250 stores. So when you're analyzing a business, scalability is very important. Not all businesses are as scalable. Jubilant Foods, your Domino's Pizza, for example. What is their simple business model? Open a cloud kitchen or pizza store, make it profitable, open more stores, sell to more people. That is the basic business model. So there is a factor of scalability in that. If there are 5,000 places where they can cater to in India, and currently they are only running 800 stores, for example, then you know that the model is scalable and the opportunity is big. Next point in S is superior competitive position. I only want to buy companies that have demonstrated or proven some form of competitive superiority. That shows me the DNA of the company. If I am betting on a company that in their history has not demonstrated any clear signs of competitive leadership, that means I don't know whether they can do it going ahead. And that is why to identify superior competitive position is very important. And how do you identify that? There are, as I told you, operating metrics. When you see HDFC Bank, you see their NIM, you see their NPA, you will understand that SBI ka NPA 4% hai, HDFC Bank ka NPA 1% hai for the last 15 years. That is proof of competitive leadership. Like that, for every industry, you should be aware of the 3 to 5 important metrics, compare companies on those metrics, and then decide which is the better stock to buy. A is for two things: accounting quality and advantageous capital framework. Accounting quality, what does that really mean? Is the company transparently reporting the good and the bad? Is the cash flow statement of the company conveying a similar story to the P&L statement of the company? Is the company having auditors consistently and they are having clean remarks about the company, etc., etc. Advantageous capital is the second A. What do I mean by this? The ability of any business to create capital, generate returns on that capital, and redeploy that capital to generate higher returns consistently. Every business is not like this. In fact, very, very few businesses give you the advantageous capital framework. And therefore, it is very important to identify how consistently is a company generating free cash, free capital. Is it able to redeploy that capital and earn the same return on that new capital? This analysis is very important. And the last two, I'm going to not take too much time on this, because once you've done the first, you will automatically understand the last two. I is for internal and external levers for growth. I'll explain you all. I'll start with advantageous capital framework and why that is very important. So every company and every industry is defined by its characteristics of how much capital it can create, what return can it generate on that capital, how much free capital it can create, and can it redeploy that capital in the business to earn the same returns. If you understand this whole flow, this is going to be the most defining characteristic of an investable quality business. I will explain it in little more detail because I think this is extremely important. If I'm able to generate some return on the capital that I've put in the business, but once I generate that return, I'm not able to redeploy that money into the business to earn incremental return. That is not a good sign. So create capital, generate return, redeploy capital to generate high return. ये पूरा piece जब बैठता है, you've got a beautiful business. Don't let go of such businesses. And if you screen 500 stocks, you will find 40, max 50 companies that have an advantageous capital framework. So it is very, very important for you to identify the capital framework of any business. The next point is I. Again, for I, we have 2 points: internal and external levers for growth, innovative and agile. Internal and external levers for growth means last 5 साल 10 साल में कंपनी ने जो ग्रोथ किया वो किया. इधर से आगे क्या? How do I identify इधर से आगे ग्रोथ कैसे आएगा? रेगुलेशन चेंज हो रहा है, डिमांड सप्लाई डायनामिक्स चेंज हो रहा है, बिकॉज कोई ट्रेंड चेंज हो रहा है जिसके वजह से मेरा प्रोडक्ट का डिमांड बहुत बढ़ जाएगा या बहुत कम हो जाएगा, वो सब देखना है. फॉर एग्जाम्पल PVR एंड आइनॉक्स, कोविड, you know, nobody is going to the cinema. You know what happened to Netflix ka share price. You know what happened to PVR ka business. Simple points, but you need to be aware and you need to have a framework so that you can analyze stocks in a framework. That is the most important skill you need to learn. Now, the next point is innovative and agile. So once you see कि over the last 5, 7, 8 years, is company keeping pace with changing times? Is it introducing new products? Is it introducing new services, new pricing policies, new technological solutions? ऐसा company क्या कर रहा है which is enabling it to stay relevant in the dynamic world of business and competition? Once you are able to identify this trait, what you should finally look out for is एक ही question पूछना है. Is this company the disruptor, or is this company going to get disrupted? If you have an answer to this question, then you've really reached a good point in your overall analysis of a particular business. The next and the last point is C. Two things here. Circle of competence, which means people are saying good things about a business, but do I understand it? If yes, it is in my circle of competence. If no, even if it is the best business, I will not be able to make money out of it in a long term. I will fail when the markets go against me, and I will sell my stock and get out of it. Lot of people give you examples of legendary Indian and global investors who say, okay, for example, everybody must be aware about Mr. Sir Rakesh Jhunjhunwala. He has seen Titan since the last 10, 12, 14 years, and he still holds his position. In these 14 years, the markets must have corrected so many times. The stock must have corrected 50, 60, 70% also in some phases. He has not given up on his position because he could understand the business, see the future, see the potential, and therefore hold it. Buying इतना easy skill है. अगर मुझे buying, holding और selling को एक score देना होता, तो buying सबसे useless skill है, frankly. Holding सबसे उससे tough है, और बेचना तो उससे भी ज़्यादा tough है. कभी-कभी you have to exit a certain stock because a lot of things have changed, but you don't understand it, or you didn't do your homework. So you can't exit at the right time. You've lost your money. Sometimes you exit because you think something has changed, but actually kuch badla nahi hai. And then you exit too early and you again don't make money in the long term. So always try to ask yourself, buy karne ke baad, before you sell, always focus on the importance of holding. और आज का मैं जो सिखा रहा हूं वो याद रखो कि होल्डिंग बहुत ज्यादा इंपॉर्टेंट स्किल है और सेलिंग बहुत ज्यादा इंपॉर्टेंट स्किल है. और सेलिंग करने के लिए कुछ ना कुछ रैशनल बेसिस होना चाहिए. आपके पास कोई रीजन होना चाहिए वो स्टॉक बेचने का, एंड दैट रीजन कैन नॉट बी प्राइस. भाव 20%, 50%, 100% भी ऊपर गया, यू डोंट सेल. But if you are justifying yourself कि भाव 100% ऊपर गया, अभी इसका P मल्टीपल हो गया 100, इधर से ये स्टॉक री-रेट नहीं हो सकता है, I am selling it, okay. You had a reason to sell, and I'm okay if you sold with a reason. Just because of price, if you sell, doesn't make sense. So guys, this is a brief overview of the MOSAIC framework. I hope it helps you all and you all can use it in your investing decisions. Be disciplined, focus on this, and I'm going to take you all through some other things. This is another framework we use for a different reason. I'm not going to confuse you all today with two frameworks, so I'm going to stick to MOSAIC. Maybe if we are doing one more session in the future, I will take you all through CropSup. But I will spend 1 minute to tell you all that CropSup is a very novice-friendly framework. It is very simple. इसमें 6 points है. Create excellence, reinvest sustainably, value creation, protect persistently, share honestly, understand simply, and pay reasonably. Create excellence मतलब कंपनी ने कुछ फॉर्म में excellence create करना ही चाहिए. Distribution, market share, margin, returns, cost structure, kidhar na kidhar it should be an excellent company. री इन्वेस्ट सस्टेनेबली इज सिंपल. अगेन एक ही मिनट, मतलब 1 मिनट से भी कम में समझा दूंगा. मैं जो पैसा कमाता हूं उसको मैं मेरे बिजनेस में री इन्वेस्ट कंटिन्यूअसली. आई शुड बी एबल टू री इन्वेस्ट इट. Offer value creation is economic value addition should happen. Protect persistently means if I have some strong entry barriers or moats, as I call it, I should be able to protect them. Having a light entry barrier is not good enough. Having the entry barrier, making an effort to deepen my entry barriers and making an effort to protect my entry barriers persistently, ऐसी companies हमको चाहिए. Share honestly is also very simple. We want companies that are transparent, clean, aligned to their shareholders. Because if the company doesn't share and it is not a good quality corporate governance clean company, even if the company makes its profit 5x, as a shareholder, you will not earn money. They will do some or the other cheating and you will lose. Understand simply मतलब मैं पैसा क्यों डाल रहा हूं, किसमें डाल रहा हूं, वो बिजनेस क्या है, क्या वो बिजनेस मुझे समझता है, क्या ये बिजनेस के रिस्क मुझे समझते हैं. अंडरस्टैंड सिंपली. जस्ट सिंपली ट्राई टू फॉर्म योर इन्वेस्टमेंट थीसिस एंड देन राइट दैट थीसिस. पे रीजनेबली मतलब if a company is growing at 5% and if the valuation is 100 times price to earnings, that means I'm paying a ridiculous price to buy something that grows at 5%. If a company is growing at 20% and I'm paying 20 times ka price multiple, that shows that ek saal mein I'll break even on my price earnings ratio. Basically, valuation को समझना है and simply समझना है. बहुत complicated कुछ नहीं करना है. Simply समझो and pay reasonably. If you are buying something on Amazon and then you're going to Chroma to buy the same thing, इतना तो आप सोचोगे ना कि ये टीवी मुझे Amazon में 40,000 का मिल रहा है, क्रोमा में 35,000 का मिल रहा है, बट ऐसा सिमिलर टीवी सब फीचर है, सिर्फ एक फीचर नहीं है, मुझे 20,000 में मिल रहा है. तो पे रीजनेबली, सेव योर मनी, बाय समथिंग विच इज गुड बट रीजनेबल ऑल्सो. सो सिंपल लाइफ के कॉन्सेप्ट्स है जिसको आप इन्वेस्टमेंट में अप्लाई कर सकते हो. फाइनली मैंने आपको जो बोला था होली ट्रिनिटी, वो 3 चीज का है, क्वालिटी, ग्रोथ एंड वैल्यू. अगर ये 3 आप समझ सकते हो और इस पे मेहनत करके एक व्यू बना सकते हो तो यू विल बी सक्सेसफुल. बिकॉज ये जो लाइन है, नॉइज बिटवीन द ईयर्स इज हायर देन वॉलेटिलिटी इन स्टॉक प्राइसेस. इसका मतलब ये है कि एवरी डे मार्केट में, मार्केट का रूल धर्म यही है कि रोज प्राइस बदलेगा, या ऊपर जाएगा या नीचे जाएगा. सो एवरी टाइम द प्राइस गोज डाउन, आई स्टार्ट थिंकिंग अरे यार ये बिजनेस का क्या होगा, मेरे प्राइस का क्या होगा, मेरा पैसा टूट जाएगा क्या, मतलब यू कीप गेटिंग दोस स्कैरी थॉट्स. बट if you've understood very simply and clearly your business that you are buying, you will avoid that noise in between your ears and therefore be able to ride the volatility. And मैंने आपको जो golden principle बताया है कि you need to have a well laid out investment framework to comfortably navigate the market, comfortably buy stocks, comfortably make money. तो आप फोकस करो फ्रेमवर्क पे, स्टॉक्स अपने आप वो फ्रेमवर्क में बैठेंगे और अपने आप वो फ्रेमवर्क से निकल जाएंगे. यू फोकस ऑन गेटिंग द फ्रेमवर्क राइट. एंड ये जो लास्ट फ्रेमवर्क है हमारा, कॉन्क्वेस्ट फ्रेमवर्क, ये आपको किसमें हेल्प करता है, क्या खरीदना है उसमें नहीं हेल्प करता है, कब पकड़ना है और कब बेचना है, when to hold, when to sell. This is what will help you in that. Conquest is few words. I will take you through few simple characteristics of the framework. कि बिजनेस में लॉन्ग टर्म फंडामेंटल्स चेंज हो रहे हैं, वॉल्यूम ग्रोथ कम आ गया, प्राइसिंग पावर इरोड हो रहा है, बहुत सारे कंपेटिटर्स आ रहे हैं तो मार्जिन्स इरोड हो रहे हैं. फॉर एग्जांपल कुछ साल पहले एलईडी लाइटिंग इंडस्ट्री में 10-15 नए एंट्रेंट्स आ गए. तो इतना सारा जब सप्लाई बढ़ जाता है कोई एक चीज का, तो ऑब्वियसली पीपल विल वांट टू एंड हैव टू सेल इट फॉर चीप, नहीं तो माल ही नहीं बिकेगा. व्हाट हैपेंस व्हेन दिस काइंड ऑफ अ इंडस्ट्री scenario plays out, your margins decrease. And then at least for 1, 2, 3 years, that industry and all those companies stay under pressure. So what do I have to think? 2-3 साल तो ये business पे मुझे अभी weakness लग रहा है. I will review it later. And again, if it fits in my framework, I will buy it again. Like this, you need to be aware of new age disruption, unpredictable material events, which after they've happened, you need to know how to act. Extreme valuations in companies, whether extremely cheap or extremely high, you need to use these extremes to make decisions. Finally, मैंने 3 simple case studies लिए हैं जो सबको समझ में भी आ सकते हैं और सबने मेरे हिसाब से ये सब नाम सुने होंगे. So पहला है TCS, world's largest IT company by market cap is Indian company TCS. I hope you all have heard this name before. And what I have done is plotted TCS and Wipro to show you how numbers tell you a story and how you should look at these numbers in a particular perspective. TCS का 10-year का EBIT margins का track record है 26%. Wipro का है 17%. TCS का earnings growth है 17% for the last 10 years. Wipro is at 8%. TCS का ROE is at 37% on a 10-year basis. Wipro is at 20%. And if your basic fundamentals are good, natural outcome is your stock price will do well, you will make money, you will make returns. So TCS का stock CAGR is 19%. तो पिछले 10 साल से every year consistently TCS is growing at a 19% rate and Wipro is growing at an 8% rate. So to put things in perspective, always find out some simple numbers which will help you understand ये कंपनी अच्छा है, ये कंपनी इतना अच्छा नहीं है. एंड उसके लिए बहुत कॉम्प्लिकेटेड एनालिसिस की जरूरत नहीं है. सिंपल रखो, समझो और उसके बाद एक्ट करो. HDFC Bank is the next example I'm going to give you. And I've also put SBI along with that so that you understand the difference. ये जो हम क्वालिटी का डिफरेंस बात करते हैं वो है कहां और कहां. How do I come to know what is good quality? Let's look at net interest margin. Maybe it's technical for you all, but net interest margin is बैंक का business model क्या है? मैं लोगों से पैसा लेता हूं, वो डिपॉजिट करते हैं, मेरे साथ सेविंग करते हैं एंड वही पैसा मैं कॉर्पोरेट्स को, लोगों को लोन करके देता हूं. तो in that difference, what do I make? That is my net interest margin. Very simple. So HDFC Bank is working with a 4.1% net interest margin. SBI is working with a 2.8% net interest margin. So HDFC Bank is good, better. Gross NPA. NPA means what? कि अगर मैंने 100 रुपए की लोन दी है तो उसमें से कितना पैसा है जो मुझे वापस नहीं मिलता है. HDFC बैंक का 1.1% उसको वापस नहीं मिलता है. SBI को 6% वापस नहीं मिलता है, which is really bad. That means ROE is going to be higher for HDFC Bank because NIM भी higher है, NPA भी कम है, तो ROE automatically बहुत high हो जाएगा. So HDFC का historic 10-year ROE is 19%, SBI is 8%. If fundamentals are in place, automatically what happens to stocks? You see the stock returns 23% compounded over the last 10 years and SBI 4%. Again, I was telling you all, look at a company, find out simple metrics, do your simple analysis, and then hold with conviction. Because returns will flow if your basic reason and analysis is right. Now, this is something I want you all to avoid. I don't know if you all have heard of this company called HEG and Graphite India. Once upon a time, few years ago, this was the multi-bagger stock. कुछ 3-4,000% रिटर्न दिया था एंड अगले साल 3-4,000% नेगेटिव भी गया था. सो कमोडिटी स्टॉक्स, cyclical stocks, these are for pros. Pros means जो वो इंडस्ट्री के बारे में बहुत सारा जानते हैं, जो वो इंडस्ट्री के रियलाइजेशन ट्रेंड्स, वॉल्यूम ट्रेंड्स, डिमांड सप्लाई ट्रेंड्स को बहुत बारीकी से समझते हैं. ऐसे स्टॉक में अगर आप at a wrong time चढ़ गए, then forget wealth creation, you will end up wealth destruction, doing wealth destruction. So I'll show you all. This is the price of graphite electrodes in the world. So there was this 1 year in, one second, around 2017 onwards, where the graphite electrode prices started increasing because China में बहुत सारी फैक्ट्रीज पे बैन आ गया, तो सप्लाई वर्ल्ड का कम हो गया पर डिमांड उतना ही रहा. फॉर दैट रीजन स्काई रॉकेट हो गया ग्राफाइट इलेक्ट्रोड्स का प्राइस. एंड ऑब्वियसली जो इंडिया में 2 ही कंपनी है जो ग्राफाइट इलेक्ट्रोड्स में काम करते हैं, विच इज HEG एंड ग्राफाइट. तो अगर ग्राफाइट इलेक्ट्रोड्स का प्राइस ऊपर हो गया तो ऑब्वियसली उनका रियलाइजेशन इंप्रूव हो गया, उनका प्रॉफिट इंप्रूव हो गया. बट बिकॉज दिस इज अ कमोडिटी, ये जो प्रॉफिट इंप्रूव हुआ वो सस्टेनेबल नहीं है. ये 1 या 2 साल में ऐसा अनरियलिस्टिक प्रॉफिट आ जाता है, but it is not sustainable. So price went from 200 rupees to 4,000 rupees between that period. But this is not sustainable because next year you see how the stock has crashed. And from here on, for it to go back to 4,000 level, it's looking very, very difficult in the medium term also. So now imagine the state of a person who bought this stock above 3,000, 4,000 rupees. He will never get his money back and it's a permanent loss. Which is why when I say understand the business, it is very important to understand कि आप commodity cyclical business में हो, आप structural growth story play कर रहे हो, क्या कर रहे हो. My next example is on a commodity business, but which has done very well. So I was telling you there are 2 parts. There is science and there is art. So science tells me कि commodity business में पैसा टूटेगा, पर ऐसा नहीं है. कौन से type of commodity business में value creation हो सकता है? So I have used the example of Divi Slabs. Divi Slabs is a pharmaceutical company in India, which is in the business of API and raw material manufacturing for other pharmaceutical companies. Basically, जो वर्ल्ड की बड़े बड़े MNC फार्मा प्लेयर्स है, लाइक योर फाइजर, सैनोफी, एस्ट्राजेनेका, एबॉट लैब्स एटसेट्रा, वो उनके लिए उनका रॉ मटेरियल मैन्युफैक्चर करते हैं जिसको हम API बोलते हैं और एक्टिव फार्मास्यूटिकल इंग्रेडिएंट. अभी ये बिजनेस कमोडिटी है, इसमें तो कुछ मैं स्पेशल कर नहीं रहा हूं, रॉ मटेरियल ही सप्लाई कर रहा हूं. तो इसमें डिवी स्लैब्स ने इतना वैल्यू कैसे क्रिएट किया? To understand that, what we will do is understand the other side of the pharma business. There is companies like Sun Pharma, Lupin, which are into generics and formulation, which means कि कोई भी दवाई off patent जाता है, they start making the same medicine for cheaper and selling it. So any MNC company will not like to work with them because they know that if I do any work with them, they will eventually copy me. What Divi Slab did is, it said, I will never copy anyone. I will only keep supplying raw materials to all the MNCs. By doing this, it did not change its business model. It did not move up the value chain. And therefore, it is able to create an annuity business and create a lot of value for shareholders, investors, and the company. So, such kind of subjective analysis is also important in companies and industries where you don't have a very clear understanding के क्या हो रहा है यहाँ पे. So Divi Slabs ने last 10 years में grown its profit by 16%, grown its operating cash flow by 14%, which is synchronous, maintained its ROE above 20%, but the stock has compounded by 28%. So there is also a re-rating factor. Why is there a re-rating factor? The re-rating factor is because everybody believes कि ये जो essential business में है, इसका बहुत longevity वाला demand है. Means 10, 15, 20, 30 साल तक all the MNCs will want to make medicines. They will need their APIs and they will buy from Divi Slabs only. because Divi Slabs does not cheat them. Divi Slabs does not compete with them. And that's why it has got a 40, 50, 60 P multiple in different cycles. Other pharma companies trade at 15, 18 multiple. So this is an example of how value can be created even in a commodity business. That's it from my side, guys. I'll be really happy to take any questions that you all have. And if anybody wants to open an account, here's the link. And if anybody wants to email me personally, that is my email ID right there. Thank you so much. Any questions?
Yeah, thank you so much, sir. Yeah, thank you so much, sir. And I must say that it was really one of the finest topic and one of the finest session till now in the stock market series which we are having right now. And I'm sure that many of the session people would have the questions. So if anyone have any question, you could definitely take the advantage of the sir's presence over here. So there is a question in the chat box. So if you could reply.
One second, how to tap diversion of funds? What? I didn't understand that question actually.
Yeah. So if you could elaborate your question, what is your question? So also someone asking for good books to understand for fundamental analysis.
There are lots of books, but I really like all the books written by Peter Lynch. Yeah. So just Google Peter Lynch and get his books. That's really, really good. Diversion of funds, excess of investment, loans. So you need to track related party transactions. You need to track the history of the company, that over the last, say, 3-4 years, how many subsidiaries and, non-vehicle style companies is it creating where it is doing transactions. So I think what you're focusing is on related party transactions. I guess you need to track that on the balance sheet.
Yeah. And also must
say that again, let's come back to my framework. See, the framework tells you if you vetted the original quality of the company, you don't need to look at this. Then you focus on other things. If you red flag the company and if it's eliminated because of related party transaction, corporate governance, accounts that are not clean, then you will face all these issues. Once you filtered them out, you should not get companies where you have to analyze all these data points.
Yeah, absolutely, sir. So, sir, what we had learned really from today's session is that 90% of successful investing would be to finding a great investment, and the other 10% of successful investing would be to find a great stock, and the other 90% would be to never sell the stock. Is it right, sir?
I think 90% is investment framework and 10% is sticking to that framework. That is how I would summarize it.
Yeah, and I must say that जो sir आपने सिखाया है कि never go into the complexity, just go with the basic ratio analysis and never make your investment framework complex. Always to keep it very simple. And sir, one more thing we would like to mention is that जो आपने बोला कि अगर next session अगर availability होगा तो we would discuss about the other framework also. I'm sure that all the participants would be keen to learn about the other framework also, and we would talk with the Ahmedabad branch. If it would be possible, we would try to arrange another session for that framework also.
Yes, done. Whenever you want, let me know, and we can do a session again.
Yeah, sure. Thank you so much. Thank you so much, sir, once again for your time and for sharing your great amount of research work and your experience. Thank you so much, sir.
I really hope people have taken 2 or 3 important points out of this and it will help them in their investment journey.
Yeah. Nikita, would you like to add?
Yes, definitely. Thank you so much, Siddharth sir. Especially the simplicity with which you explained and the last bit of it, the case laws made it so clear. For an amateur also, it has been, it can be very, very fruitful, I'm sure. Thank you so much, Siddharth sir.
Thank you. My pleasure. Yeah, my pleasure.
Thank you so much.
I can relate to all the CA guys because when I was also doing CA, like everything was so theoretical and I didn't find it that practical.
Absolutely.
But now when I look at it from a different perspective, I told you, right? This one slide, this is all I needed from CA. Nothing more than this. इतना ही मुझे समझना है. CPT to CA final का इतना अगर समझ गया तो मेरा investing का काम हो जाएगा.
Sir, or if it would be permissible, could you share your any sectoral view or this talk a specific idea?
I don't think this is the forum for that. Because when I look at a sector, I also know how to get out of it. अभी आज मैं कुछ view दे दूं, 2 महीने में मैंने मेरा view change करके मैं निकल गया. आपसे कोई सुन के मेरे पे पैसा मतलब कोई call पे पैसा डाल दिया.
I think so more important would be to learn the fundamentals and
learn, do it yourself, guys. Learn it and do it yourself.
Absolutely.
Or give it to the expert. Don't listen to an expert, buy it, and then don't exit at the right time. You know.
Right. Right.
True.
And also, we would request everyone to share your feedback. We had already shared the link to give your feedback. So it would be very interesting to get the feedback from all the participants.
Okay, thank you, Jitendra and Jignesh. Thanks a lot.
Yeah. So thank you so much, everyone. Thank you so much, sir, once again. And with this, we would like to end the session. Thank you so much.
Thank you, everybody.
Okay. Bye. Bye.